with that, we now like to invite Vinay Khattar, the head for research at Edelweiss Wealth, joining us live right here. Vinay, before we get stock specific, before we, start talking about the new ideas that you're floating, just a quick word and update on what it is that Edelweiss is also telling its clients for when it comes to this year. We on ET now have been talking about how our viewers can prepare for the next bull run. And as we do that, what is it that Edelweiss is telling its clients? A year of zero returns, negligible returns?
Hi, morning. So the way we see the markets, our first half in the calendar has been fairly stressful. Now, we all know that the primary driver of this stress is coming from abroad. This is a US-led correction, which was driven by very easy monetary policy and leading to massive high inflation. And obviously now you find Fed coming in very aggressively and trying to correct that inflation. All the emerging markets have been seeing significant outflows, and India is no exception. But if you look at actually MSCI Emerging Market Index, the outflows from emerging markets started somewhere in Jan-Feb 2021. But Indian market started seeing correction exactly 12 months later, post Jan-Feb 2022. So 6 months have been quite bad. Our markets have corrected by almost 16% from top to bottom. Nifty indices, the other smaller cap indices have got beaten up much more. Now, what do we see in terms of value? At 15,000 to 15,500 range, our sense is that value is beginning to emerge. FY24 EPS is likely to be closer to 1,000 rupees. It was upward of 1,027. It has got corrected a bit more. The earnings have come down in last quarter, and this quarter probably you would see some more correction. But we don't see a significant correction or downgrade in Nifty earnings for FY24. Given the overall structure of the markets and if you study across sectors. So if 1,000 rupee Nifty EPS was to, or a closer to that number was to stay intact, at 15,000 levels, Nifty is trading at 15 times. Now, if you study historically Nifty earnings and PE multiples, Nifty rarely goes down below 14 and a half, except in case of extreme emergencies and that too for very short periods of time. So 15,000 to 15,500 is a extremely good level for people to start deploying some amount of capital. Moving beyond that, I mean, how do we see the rest of the year panning out? I think a lot of that will depend upon how the Fed reacts. Now, we all saw inflation print come out of US a couple of days ago, almost 9%. That's a fairly high number. But if you were to move beyond that number, what is exactly in the price? So there are two things which are clearly playing out. One is that Fed has already said that in the last policy meeting, that the July policy will see the Fed fund rate going up to 2.5%. That is another hike of 50 to 75 bips. So that will take the Fed fund rate closer to about 2.75%. Can there be another hike of 50 to 75 bips on top of this, which could take us maybe towards August and September? That's a possibility. So you could see a Fed fund rate closer to 3.5% by August, September. And then there is a reasonable chance that there could be a pause. And why do we say that? One, the massive hike that the Fed is taking, it will take time for the hikes to flow through the system in terms of cooling down of demand.
Right.
We are seeing some early action in terms of cooling down of demand.
Of course, Vinay, we are all watching out for that. That's going to be the big cue. Vinay, that's of course going to be the big cue when we'll know when the FOMC meet takes place on 25th and 26th of July, 100 basis points, 75 basis points. We're all waiting for that. But something else, it's very clear that the markets have had shock absorbers, as the finance minister likes to call them, the DIIs. But within that, I'd like to ask you about the HNI segment. What's the sense that you folks are getting? What are the HNI's assessment of the markets? Are they panicking?
Not now. So most of the people either exited early, more like in February, March. And since then, a lot of money has been on the sideline. we see some initial trends of people beginning to deploy capital, but that is still early days, and some stock picking is beginning to happen. But is there a large influx at this particular point in time? We don't see that. Probably another month or so, and how the Fed reacts would determine the kind of inflows that we begin to see. But a very important factor that will play out here is whether we see FII exits toning down or stopping. That's a big joker in the pack. So till the time that doesn't clearly play out, the big money on the HNI side is going to be doing some nitpicking, but not major inflows is our sense.
Good morning. Just checking the India strategy, and themes that stand out here are consumption and capex. You believe that that's where we're going to see leadership. Don't you believe that the high interest rate, the high inflationary environment could be deterrent for both of these sectors?
So right now, the demand appears to be just too strong. Our channel checks across the board are telling us that people or corporates are not seeing too much of demand contraction. Okay, and this quarter's results are going to be extremely important. Another 15 to 20 days or 30 days, we'll have a lot more ideas as the con calls across sectors begin to play out, and what the managements are speaking in terms of demand contraction, given the hike in interest rate and higher commodity prices and so on and so forth. But we must not forget a couple of things. One, the commodities have begun to correct aggressively across the board. So probably the impact of slowing down of demand, even if it was to happen, would be a shorter term phenomena, and then it could play out. Second, in terms of specifically coming to capex and consumption, if the demand stays very strong, the capex commentary was extremely strong, let's say in December, January, right? All of us were listening to corporates talking about undertaking aggressive capex, which has not really happened so aggressively over the last some time. And if that capex cycle was to play out aggressively, our sense is a lot of stocks can do very well. Even on the consumption side, let's look at what's happened this quarter. You had margin compression because of higher input prices. A lot of FMCG companies and so on have taken either the price hikes or reduction in grammages. Now, as the commodities begin to ease off from the next quarter, some of these trends could get reversed. So you could that could either lead to a higher margin or a pull up in demand either way. So overall, if you look at the entire picture, entire space, a shock in terms of demand is not what we are expecting. A lot more clarity will emerge in probably a quarter or so.
Okay, and does that extend to sectors across the board, like even construction, real estate?
Real estate, of course, yes. So real estate, a big pickup is happening after 7-8 years of slowdown in the cycle. Now, real estate is hugely driven by the salaried class. And at this particular point in time, the job scenario doesn't look weak at all. Middle class and across the board, professionals have got significant hikes. IT is a big driver of this particular demand. So that's one big factor which is playing out in terms of real estate. And plus, there has been a massive consolidation. And even if you were to adjust for some 100 bips hike in interest rate, do we see a significant cooling down in terms of demand? At this point, no.
Okay, Vinay, we'll let you go on that note then. Thanks so much for taking time out and joining us and sharing with us your outlook on the markets in individual sectors. Let's slip into a quick break then right here on the show. Be right back with more.